Hello. Today we cover the most dangerous corner of investing, trading with borrowed money. Picture this. You have $1,000 in the account, and your broker says, "We'll lend you more buying power." Suppose you end up controlling $6,000 of stock. What if that position drops 20% in a single day? The loss is $1,200, but you only had $1,000 of your own cash. That is the dead investing trap. You can lose your principal and still face forced liquidation, so the damage snowballs. Today we look honestly at the structural risks of margin buying, short selling, and settlement shortfalls. Margin buying means your broker lends you cash, credit, so you can buy more stock than your own money alone would allow. Example. With $1,000 of equity, you might control roughly $2,000 under standard Reg T 50% initial margin, and aggressive setups can push buying power much higher. You are trading a multiple of your own capital, and the borrowed balance usually carries interest, often in the high single digits to low teens annually at retail brokers. Hold for 30 days, and interest alone can add up to tens of dollars on a few thousand borrowed before any price move. The sharper risk is maintenance margin. If the stock falls, your broker can force sell your shares whether you agree or not. Many brokers issue a margin call when equity slips toward the mid-20s to mid-30s% of the position. Exact thresholds differ by firm, so check yours in advance. Miss the deadline to deposit more cash, and the position can be liquidated automatically. The deadliest risk in margin trading is forced liquidation, the margin call that sells you out. Even on the chart in front of you, you can spot sudden down legs. When equity falls below the broker's maintenance level, the firm can sell your stock without your consent. That is the broker protecting its own loan, not protecting your plan. FINRA and the SEC have repeatedly warned that retail margin losses in sharp sell-offs can far exceed what investors thought they had at risk, especially when forced selling stacks on top of the drop. Why? In a crash, the gap between a conservative mark used for risk control and the price you actually get filled, it can be huge. Slippage and thin liquidity do the rest. Forced selling at the worst moment turns a margin shortfall into much larger realized damage through extra slippage. Short selling is the mirror image of margin buying. You borrow shares, sell them now because you expect a decline, then try to buy them back cheaper later to return them. Stock borrow fees vary widely. Hard-to-borrow names can be expensive, and your broker can demand the shares back at any time. Exchanges also run short sale restrictions after large down days, which can block new shorts. Here is the critical difference. On a long margin trade, losses are still bounded by how far the stock can fall toward zero. On a short, losses are theoretically unlimited. There is no ceiling on how high a stock can climb. Short at $100 and it runs to $200. That is a $100 loss per share. At $300, the loss is $200 per share. In an extreme squeeze, a 100% rise can wipe out capital on the order of your notional short, and that is before borrow fees and trading costs. The core short sale risk is that there is no theoretical upper bound on the loss. A settlement shortfall is the everyday cousin of margin and shorts. The cash is not there when the trade must clear. Because it feels ordinary, beginners often underestimate it. Example, you sell shares on day T, but under the UST plus one settlement cycle, the cash is not fully available until the next business day. Spend or trade that money too early, and you can trigger a good faith or free riding violation. If a debit balance sits unpaid, interest can accrue day by day. Repeated settlement violations can bring trading restrictions, often a 90-day limit on using unsettled funds. Unlike a discretionary margin trade, clearing and settlement rules are obligations. Ignore them, and you can face account restrictions or a damaged brokerage standing. Beginners miss how fast that snowballs. A $5,000 unpaid debit at roughly a 12% annualized rate can pile up tens to low hundreds of dollars of interest in a month or two before any new bad trade. I do not recommend margin trading. If you still use it, 4 rules raise your odds of surviving. First, keep a wide cushion above maintenance margin. Deposit cash before a margin call appears. That is the most effective defense. Second, cut and settle when the loss is only about 5 to 10%. It will bounce back is the most dangerous trap on borrowed money. Third, keep margin holds short, on the order of weeks, not months. Interest keeps compounding the longer the debit sits. Fourth, never put more than about 30% of your total net worth into margin positions. Protecting your life capital is the smarter decision. Margin buying, short selling, and settlement shortfalls share one core. They're all ways of investing with obligations you do not fully own yet. Gains can look 2 to 3 times larger, and losses can be 2 to 3 times larger too. On top of that, forced liquidation can close you out against your will. When regulators and self-regulatory groups publish investor alerts on margin, treat that as a signal that real retail damage is rising, not as background noise, especially in Fed-driven risk-off weeks when the S&P 500 NASDAQ can gap hard. This lesson is for education only. It is not investment advice, not a solicitation, and not a promise of profit. Every decision and every loss is entirely your responsibility. Next time we flip the script and cover safer dividend stock investing. Please subscribe and leave a like if this helped.